Hello and welcome into the KE Report. Shad and Corey here, getting our first big general editorial of the year with Chris Temple, editor and publisher of The National Investor. And Chris, it's always great to get you on the KE Report just to see what investing themes are on your mind. As we flip the calendar into a new year, it's always good to look at any big mega trends or any market themes that anybody has in their mind. And you had a good one for 2025, and it really boils away a lot of the BS and gets to the heart of the matter. I'd love you to share with investors what you were sharing with us off mic about your theme of let's do the math.
Well, sure, Shad and Corey, Happy New Year to you, to our audience out there. It's good to be back with you. Yeah, you know me, I call things as I see them. I call balls and strikes, like our mutual friend Des O'Kell likes to say on his podcast. I'm not for or against any politician or political party. I believe in what makes sense, what is demonstrable, etc. And that said, my own broader 2025 forecast, which will be out imminently, it does have that theme. Let's do the math. Donald Trump, for the second time in history, is a president to serve a second non-consecutive term. There's a lot of good reasons why the American people supported him and wanted a change from what we've seen in the recent past. But promises and the hope of better things, better policies to come, still have to deal with the laws of mathematics. And in almost anything you want to consider, whether it's the president's promises on increasing energy production and lowering prices, whether it's about trade, whether it's about the budget, whether it's about taxes, whether it's about our crying need to have a crash course to reinvigorate our domestic minerals industries along with energy. We've got to do the math. We've got to look at what is mathematically and logistically possible. And almost everywhere, with just a few minor exceptions, the math is against what Donald Trump says he wants to do. So it's going to require a lot of thinking and acting outside the box. I will say that going into Trump 2.0, in my opinion, he is surrounding, or at least attempting to surround himself with a lot better quality of people who are true patriotic Americans rather than swamp creatures that he was rearranging in his first term. And, I want him to succeed. I think the whole world has a stake in him succeeding in making not only America great again, but in doing a better job for the rest of the world as well. But, again, I think that we need to look at the math in a lot of different areas. And I hope the president does that as well, because there's a lot of things that are going to be against him, from the budget to a Congress where he still does not have any more friends than he does enemies when you get right down to it, etc.
Chris, if we're talking commodities too, and I know we're going to tie in a wide range of commodities, as much as we focus on US and what Trump might do, it's also a global game. So how much do you balance out how big of a difference Trump can make, but also what the rest of the world is going through?
Well, here's the thing, and this is one of the areas, and frankly, it's one of the biggest ones, Corey, where I think that we all need to do the math, and that Trump and his people need to do the math and understand what they're up against. It's one thing to have political rhetoric that says we want to contain China, we want to outcompete China and all these kind of things. The fact of the matter is that we are ending 4 years of a Biden-Harris administration with even less of an ability to compete globally against China than what we had before. More so, and this is the single most important thing anybody, investor, economist, frankly, even consumers, because it's going to affect everybody's consumers, can look at in the year ahead. You have got the two biggest economic blocks in the world, economies in the world, China and the US, that could not more so be going in opposite directions. In the US, we still have an inflationary impulse. There's still a truckload of money sloshing around and credit sloshing around in markets, even though the underlying economy is not as strong as 50 or 60% of the population will tell you, as it appears to be. The inflationary impulse and just the sheer volume of debt that needs to be issued and rolled over and whatnot, where the U.S. is concerned, has created a situation recently that has only happened twice in history, The other time being in the early 1980s, and that is the Federal Reserve has cut short-term interest rates 100 basis points. Since they started that, the bond market has gone up 100 basis points. So now instead of 3.6% on the 10-year Treasury, it's 4.6. Part of the reason being is that we still have this, underlying inflationary impulse. Do you guys know what China has to pay for money for 10 years?
No idea.
Nope.
1.6%. Not 4.6, 1.6. Because China, they would love to have at least some modest inflationary impulses. They are in full on deflation. The Japanification of China is underway. And it's underway for a lot of reasons. China, a lot of people don't realize, has got the biggest, when you add up public and private debt, the biggest debt to GDP ratio of anybody in recorded history. Bigger than the US, bigger than Europe, bigger than even Japan. Okay. And that has been caused by a lot of mistakes that they made over the years and relying so heavily on debt and having a major building boom. I mean, what they have done with their entire economy and real estate market and production capacity and everything is way beyond anything that the U.S. even did back in the early to middle aughts, 2005, 6, 7, that led to the real estate bust. Proportionally, China's abuse and mismanagement of debt is far beyond that. So inevitably, what happens when you either have a debt crisis like that is just too big and unmanageable, or you have an asset crisis, or both, you've got to have a reversal. And that's the road China is going down, which is why they have got, acres and acres and acres of unsold EVs, 10, 12, 14 grand a whack for the cheapest ones. The world cannot compete against that. The US cannot compete against that. Europe can't compete against it and is really getting to the point where they're going to hold their nose and say the heck with it. We don't have the political will or the brains to resurrect our own industries because they're going to cost more. We'll just hold our nose and buy the cheap Chinese imports with dirty Indonesian nickel and dirty and industrial practices in their country and so forth. So this is a big dynamic in the year ahead, and it's one of the biggest math problems that President Trump is going to have. Because I don't care what you try and do using tariffs as a sledgehammer or whatnot, we simply cannot compete with global pricing with China on a great deal of stuff. And they know it, and now they're starting to push back, as we all know from their recent embargoes of a lot of critical materials that we need.
Well, Chris, when you look at the global landscape, as you point out, China's on a completely different track, a deflationary track compared to the US's inflationary track. When you look at Europe, they are kind of a basket case. When you look at other centers of industry, there's really not a lot of strength anywhere other than China as far as the manufacturing side. And even if we move more onshoring and friendshoring over to North America, be a long process, not an event. In that kind of a backdrop, do you think there's any commodities where there is an edge? Because not every commodity is domiciled in China still, and they don't have a stranglehold on the whole global market. What commodities do you think we have a good chance of, I guess, having some exceptionalism in the United States and in Canada?
Well, the two at the top of the list, Shad, are natural gas and uranium. I think that they're two of my three favorite commodity plays as we start the new year. The third one being gold, and I'll put 3B being silver because silver I think will go up in sympathy with gold. But aside from that, in near term, I'm pretty ambivalent about industrial metals and battery metals and whatnot generally. I like natural gas because North America has got as much of it as anybody in the world. We've got great infrastructure. We've got a phenomenal cost structure to our advantage. And you don't have to have the natural price go up a whole lot more from where it is right now to have a lot of really attractive opportunities and equities because energy stocks, generally speaking, have done well, but not as well as they should have based on far better fundamentals in those industries. And you only need a static oil price of 75 or 80 bucks. Natural gas recently has doubled off of its low because for a change we've got winter in both Europe and the US. I think that over time we're going to have a moderately higher threshold for natural gas, maybe $4, give or take. We're near that right now. And at that number, and with the ability increasingly now of the US and imminently Canada to capitalize on that cheap production and export gas at a profit, those are going to be great industries. And there's a lot of good opportunities still for investors, I believe, there. Uranium is, I just did an interview myself several days back with Scott Melby, who is the head of the Uranium Producers of America. You guys know him well. He's been on your platform as well. And he and I wholeheartedly agreed that right now uranium at $75 a pound, give or take, is every bit as bullish today as it was at the bottom at $20 a pound because the demand side is getting so much stronger. And in that category as well, the US and Canada are in a much better position to be able to control our own destiny. There's a crash course relative to other things, at least, going on even in the US, where we're trying to replace the enrichment capabilities and whatnot from the recent Russian embargo, not sending enriched uranium any longer to the US. So those are, by far and away the two best commodity stories where the US and Canada are in a better position than most other things.
So on that natural gas front then, Chris, all the natural gas bulls are pointing to these LNG terminals that are being built, that are starting to come online this year. 2025 is going to be a big year for these terminals coming online. Do you see that as being a key driver in price?
Well, I think it is. I mean, not as much, Corey, as the natural gas price itself, all else being equal. Again, I think we're going to have a higher threshold price. In case you guys hadn't noticed, I think one of the benchmarks in Norway, which is one of the European benchmark prices. We think it's been a nice bounce to have, natural gas go from a 30-year low on the Henry Hub contract in the US here, $1.90 or 95, whatever it was, to again about doubling that recently. It's $50 right now in Europe. Again, because you've had, the flow through Ukraine has stopped again. Plus, people got a little too smug after two abnormally mild winters in both, North America and in Europe, and they're getting some winter over there as well. So all of a sudden, you went from this complacency of surpluses and whatnot to boom, you just snap your fingers, they're gone. So, I think that there will be some benefit on the price. More so, there are good free cash flowing, high dividend companies, not only in the US, but especially in Canada, that are just so cheap right now, it's asinine. And I'm putting more and more of those on my list.
Well, Chris, just thinking about the energy companies, the oil and gas companies, there's a lot of just pure play oil companies, but there are some companies that have a nice blend of oil and nat gas. And then there's the pure gassers that really have the most torque. Do you like some of those hybrid companies that also have the exposure to oil? What's your outlook on oil relative to nat gas? Because they are two very different markets.
Oil, I'm probably not, Shad, quite as juiced on crude oil itself having a stronger move. I don't think it's going to go down that much. I think that there's been, until recently, some undue bearishness because the supply demand fundamentals are better than the recent, weakness until recent days in oil has suggested. But look, you've got in the industry, and this is another one of those areas where I think President Trump needs to have his promises looked at by all of us and by himself in the context of let's do the math. When he was running, the president suggested that he was going to reduce energy costs for Americans by 50%, and we're going to do it by drill, baby, drill. Okay. Well, as we were talking about off mic, recapping the situation, you go back a dozen or so years, and the energy industry was in the process of committing suicide because they went and took on scads of debt because of the big shale boom. And that's what Wall Street wanted. It's what policymakers wanted. Everybody got way over their skis on borrowed money. And for a while, you had overproduction and overcapacity. The price crashed and a lot of companies went bust, and a lot of them had to reorganize. You had a lot of buyouts of the big ones taking over smaller ones, et cetera, to the point now where for the last several years, one of the reasons why old energy has been a great place to invest is that everybody wised up, they changed their ways, and now it's all about capital discipline. It's all about free cash flow, returning money to shareholders, et cetera. And the last thing anybody is going to do And several big time, like ExxonMobil's CEOs have come out and pushed back on the president's promises. And then, well, sorry, Mr. President, we're not going to increase production just because you think it's going to make you look good, because we're not going to do it at lower prices, number one. Number two, it's not logistically as possible to do it. You've got production capacity in the US, which has been running at a record now for the last year or so at 13.5 million barrels a day or so. Most everybody that follows the industry knows that that's peaking. A lot of shale plays are starting to peter out. And yes, they need to be replaced, and they can be replaced in other areas. But no one's going to go out and do it at $50 or $60 a barrel of oil. Forget it. So, I think even with my view in the near to midterm that the US is going to have more of a broad recession than what people think is in the cards. I don't think that's going to mean that oil has to collapse or that really demand is going to collapse. So I think we're going to be pretty much fighting around equilibrium, roughly $5 to $10, probably to the upside of where we've been recently. I don't think that, barring any war or major supply disruption, we're not necessarily going to see a big move higher. Keep in mind, too, that a lot of this is going to depend on foreign policy. Among other things that President Biden allowed was for Iran to bring back another 2.5 million barrels a day or something to that measure. He was trying to get Venezuela back in. And Trump is not going to immediately tolerate either one of those. He might tolerate Venezuela if he thinks he can do like Panama, go in and take it over. But otherwise, we're not going to see those, added to the supply side. So, again, not to get any more long-winded or rambling about it, I think oil is, pretty good bet, 75 to 80 bucks in almost any environment going forward. And the better companies are making money at that.
Well, and that's the thing, right? These companies are making money, and yes, we might not see extremely higher prices because of that whole demand side. A lot of countries are struggling. That's the balancing factor. What about uranium, though? A lot of positive comments about uranium. Even last year, a lot of positive news about uranium. Big tech companies taking an interest on more or less supplying power security for their AI centers, all that information. Where do you see the best opportunities when it comes to the uranium or even just nuclear equities?
You don't have to go back more than even a few years, let alone farther than that, Corey. And if you'd have suggested to somebody that nuclear energy is going to be so in again that 3 Mile Island's going to be reopened, they would have called up Happy Acres and have them send a rubber line truck for you. Because you said that's not going to happen. Well, guess what? It is. Microsoft is going to single-handedly buy the power from one of those reactors being turned on to one of the ones that wasn't damaged, of course. But look, whether it's that, whether it's AI, whether it's data centers, as time is going on, the demand side for 24/7 grid generated power is just getting more and more and more on the demand side. And uranium is going to benefit massively from that. Nuclear technology is going to benefit massively from that. A lot of companies already are. We've already had a 15 bagger with one of my favorite SMR plays. We've already had a 10 bagger from the bear market low with Uranium Energy Corporation, which probably, when you look at all of the companies of its kind, it's not only now a renewed producer, but is going to be adding more production, has a lot of upside now, having bought Rough Rider up in Saskatchewan. There's not a better pure play for uranium anywhere than UEC. Now, what you're going to have too, Corey, is that a lot of the near term producers, a lot of the better development stage projects, they're all going to get pulled closer to the present as far as when they're going to be needing to have their uranium in the market because the demand is just so great. And the really cool thing about it is, if you're looking at just the uranium price, and everybody listening to the sound of our voice right now should have a position, if nothing else, in a Sprott Physical Uranium Trust if you only want to bet on the commodity itself. We've had a pullback from 106 bucks a pound at the high to the low to mid 70s recently for a few reasons that are not going to last. And look, natural gas, which I'm very bullish on, it's part of the overall cost structure for a gas-fired power plant is 70 or 75%. Uranium is a part of the total cost for nuclear power plant is more like 10%. and there ain't enough of it. You can have uranium go to $200 a pound, which I think within inside of 2 years, we're going to see that number. And it's not going to dramatically hurt the economics of the typical nuclear power plant. So as a commodity, and I'll say it again, uranium right now at 70 to $75 a pound is every bit as bullish, every bit as actionable as it was at the bear market low under $20 a pound.
Well, Chris, I'm glad to hear you say that because a lot of people think the uranium run is now over, now that it went to 106 and pulled back, that was it. But it's hard to think that in the face of really the lack of supply. When we look around the world, we've seen problem after problem with Niger having a coup and the French supply from Orano coming offline. We've seen problems with Cameco's JV in Kazakhstan with Kazatomprom, where they already had missed guidance by 18%. And then just yesterday, literally, they were told that their contract was suspended, and they're looking into the details of how to get it back online. But when you look in Canada, Cameco is the only domestic producer in the country. There are no other Canadian producers except Orano produces a little bit in the Athabasca Basin. All the other projects aren't slated to come online until 2029. And so when you look at the growth, the only growth has been U.S. producers. But to your point, there's also an enrichment problem, and there's a couple enrichment stocks that have done well. You brought up small modular reactor stocks on the tech side; those have done well. But there's another area I don't ever hear talked about. Love to get your thoughts on it. That's utility companies. There's utility companies that actually sell the power to the companies and to the consumer. Do you think there's any opportunity for utility companies exposed to nuclear power?
Well, a couple have already had nice runs this year. We discussed off mic earlier. I think it was Constellation. Generally speaking, Shad, the utilities themselves are not going to be the where the most beta is, certainly in the area. I think what you want to keep an eye out for more so is going to be, and Scott Melby and I talked about this possibility. Actually, he brought it up, and it's intriguing. In the battery metal space, for example, and battery metals have, been going through some pain in the recent past. You've had, whether it's Tesla, whether it's the big Korean battery makers, whether it's even GM and Ford and Stellantis and others, who have decided that long term, they want to cut out some of the middlemen. They want to be able to take stakes while things are cheap and guarantee themselves some future flow of commodities. So they've directly contracted with exploration companies for lithium, for nickel, for whatever. And I think the thing to be looking for is what companies, whether it's a utility, maybe a small one, whether it's a company that owns a development stage uranium project or some of the logistical apparatuses to convert uranium, whatever. I think you're going to see much more going forward of what Microsoft wants to do with 3 Mile Island. We're going to, whatever it takes, we're going to put up the dough for this. It's going to be ours. We're going to guarantee ourselves, we don't care what happens to the power grid beyond that. We're going to have our own utility, nuclear power plant. So that's kind of what I've got my eye on right now. And what's really intriguing about this, and it's another reason why I think even some of the exploration equities, some of the better ones, are going to have a nice move sooner than some people might have previously thought. Unlike, for example, I use the gold space, okay? Gold stocks as a group peaked way back in 2011. Since then, you've had the gold price at its peak up by another almost $1,000 an ounce. Less than that now, maybe 700 or so. And yet, the gold stocks as a group are selling for two-thirds of what they were at the peak in 2011. And there's a whole lot of reasons for that, which is a story for another day. But among those oceans of precious metals companies, there's a lot of ones that really shouldn't be around. There's just too damn many of them. You got lifestyle companies, you got ones, that are trying to keep the lights on with a wing and a prayer. They can't raise money, nor should they be able to raise money if they don't have a, world-class story and project. There's not a lot of uranium companies out there because after uranium busted back in 2011, most of them went out of business. Or they decided to start hunting around for lithium or gold or whatever. So there's not a lot to pick from out there. And it's why I think that with some of the better even exploration equities out there, a lot of which haven't had a big move yet, like UEC, like Cameco, like an Energy Fuels, or maybe Next Gen and some of the others. That's it's more advanced toward development. There's a lot of other ones that are out there that've got decent projects. You don't want to throw your money at anything and be stupid about it, like some people are with the some of the tiny gold stocks, even me from time to time in the past. But it's really tantalizing to look at this relatively small universe of companies out there around a commodity, uranium, and they've survived. And it's the commodity out there which has got the best supply and demand fundamentals of possibly any commodity that you can name.
Yeah, I get that argument. I was going to ask you more about the exploration plays. The problem, too, being is that a lot of these newer exploration plays in the uranium space haven't hit very much, and it costs a lot to drill these holes, too. So it's a capital intensive game. But look, when you're an exploration play, you need to hit something early on to keep that story going. Onto the gold space. Look, we know that you are also bullish on gold. It's kind of that third pillar of these commodities you like. But as you just said, there are too many companies out there. I argue there's too many proven resources out there too that muddies the water of what is actually a good resource. How do you go about filtering through that seemingly endless amount of gold stocks you could invest in?
Well, let me give a shameless plug. Within the next few days, I'm going to be putting out at long last an update of my seminal work called This Is Still Not Your Father's Gold Market. And in there, I talk about the checklist of things you need to look at to decide what individual companies that you want to be in. Because you're right, Corey, there's a lot of them out there that are marginal stories. They've got bad economics, some of them get over their skis. I've seen a few companies in a recent past that I've even advocated selling that I liked previously, where it's either an economic problem, a logistical problem, an engineering problem, more money is needed because of inflation, whatever. What's been interesting to see, and I'll give you this one teaser, folks, there have been certain kinds of precious metals explorers in the last few years that have not had trouble raising money. Look at what they are and what they're doing and what their attributes are. And I explain this in the issue that I'm putting out. You just contact me for a free copy of this if you're interested. It's all going to boil down in the end to show me the money. Okay. When I first got into this industry 45 years ago, and quickly started getting interested in gold and resources and whatnot besides the general markets. I was able to go to the old gold conferences back in the 1980s, and there were oceans of well-to-do people there. Gold was much more of a normal thing for investors in those days. And there was a lot of interest. There was a lot of ability for companies of all kinds to raise money. 40 plus years later, most of the old gold bugs are dead. Those who are still around are already up to their eyeballs in gold stocks if they're part of the true religious. So who do you go to next? You've got to figure out a way to get generalist investors interested. Generalist investors are not interested in carnival hucksters who tell you got to buy gold because if you don't tomorrow, Biden's going to take your bank account away and you're going to have Biden bucks. They're not interested in half stories of fancy assays which don't tell you how difficult it's going to be to ever recover anything close to the numbers you're being promised. But what people have responded to are the people involved, the geologic story involved that's easy to understand and economical, and again, the whole show me the money thing. One of the companies that I love in Quebec got hit in the markets late last year in the fall. They came out with a resource estimate that was a fair bit less than what some of the whisper numbers have been. And everybody, oh, this is terrible. But what they came out with was a mine that, yeah, is going to start a little bit smaller maybe than what had been expected, but it's a mine that can be produced and make money. That's what people are going to respond to today. So there are some exploration plays out there and ones nearing development. There's a couple companies out there. One of the ones I added recently in Nevada, they just made an acquisition. And here again, this is a company that is doing some exploration. They've got some exploration upside, but right out of the gates, they're generating cash. And their share price, not surprisingly, has held up better than most. So you've got to be a lot pickier. You've got to ask yourself, what's the kind of company, not that, a dyed-in-the-wool religious gold bug is going to go gaga over, But what is a generalist investor going to look at and say, okay, that I can get my head around this. This makes some sense. And if I'm convinced that gold is going to do well because of government debt and fiat currencies, and eventually the US dollar won't be able to defy gravity anymore, et cetera, okay, this company I'll buy.
Well, Chris, I think we'll wrap it there for today because we've covered a lot, but I think we're going to have to get you back on pretty soon because we haven't even gotten into critical minerals yet. And I'd love to get your thoughts on copper and lithium and nickel, but we'll save that for another adventure. And I think people listening in should definitely take you up on the offer to find out about This Isn't Your Father's Gold Market and also your upcoming issue where you're going to lay out your 2025 overall forecast and mega trends in the marketplace. So we'll put a link to the National Investor down below this. Definitely reach out to Chris and he'll get in touch with you with what he offers his subscribers, but also get you that free issue so you can take a look at it. Chris, we really appreciate you kicking off 2025 with us here at the KE Report with some of the big picture themes you've got. We'll get you back on in the near future and dive into some of these other markets as well and dive into some of the other U.S. markets. And as always, looking forward to our next conversation.
Sounds great. I am too, guys. So thanks for the opportunity.